Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, we'll look ahead to some key inflation data in the U.S. and how it could impact Fed policy. I'm Tom Busby in New York.
I'm Caroline Hepker in London, where we're examining the consequences of Europe's sweltering summer.
I'm Doug Krisner, looking at Japan's role in recent market volatility and where things may go from here.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby. We begin today's program with some key economic data here in the U.S. out this week, including the July Consumer Price Index on Wednesday, retail sales for that same month on Thursday. Well, after some incredible volatility in the markets last week, how might this affect the next actions by the Federal Reserve? A policy meeting less than 5 weeks away now. For more, we're joined by Stuart Paul, U.S. economist with Bloomberg Economics. Well, Stuart, let's start with inflation, what that July CPI number may bring. What do you expect to see?
We're expecting to see headline inflation slowing to an annual pace of 2.9% in July from 3% in June. The core is going to slow a little bit as well to 3.2% from 3.3% in June. Now, consumers are looking for discounts, and they're finding them when they look online, when they go to auto dealerships. But some of the biggest ticket items, some of the items that take up the most space in budgets, like shelter, for example, it's just going to be a slow disinflation process. And in fact, we're expecting to see a little bit of an uptick in the pace of rent and owner's equivalent of rent inflation in the July data. And the big swing factor when it comes to inflation has been hotels, surprisingly, which created a lot of drag in June. We think it's going to create a little bit less drag in the July data, and that's going to buoy the core just a little bit.
Well, the housing market, I mean, what an uneven, you don't know what to expect month to month, but one thing is certain, it's more expensive than it's ever been. Rates are still elevated, although there's hope that they're going to go down. So travel demand, which lays right into your what you said about hotels. I mean, we have seen signs that people are pulling back now. Fewer, TripAdvisor says fewer bookings. Airbnb says fewer bookings. So they're bracing for a pullback.
That's right. So consumers are becoming quite a bit more discerning in their spending habits. When we look at things like you said, Airbnb, or you look at some of the online travel booking agencies, you're definitely seeing some of the swings month to month. If you look at where consumers are really starting to tighten their belt, it's in things like food services also, very similar to travel and accommodations. Consumers are looking to rein in on some of those discretionary services categories, in addition to some of the more interest-sensitive spending categories like autos.
There's groceries and there's food service, and there are all kinds of restaurants, from fast food, quick service, sit-down, white tablecloth. Where are you seeing the big changes in food?
It's interesting. So when we listen into earnings calls and we look at earnings reports, we see a lot of reports of dining services companies that are starting to offer discount meals and that are starting to offer discount opportunities, and they're actually seeing some more traction with consumers. When we look on the higher end, those sort of retailers and those chains are facing a little bit more headwinds. And consumers are rotating a bit more back to cooking at home, dining at home. We're expecting to see about 0.1% inflation when it comes to groceries during the month. That might not sound like a lot, but when consumers are really pinching pennies and they're reining in their spending on food services, that inflation in groceries is going to weigh on consumers.
Well, I want to go back to something you mentioned before just briefly, and that is autos. Again, very uneven, what we've seen with used car prices, new car prices. Now we have all the ads are out there. It's August. Now all the 25 models are coming in. The 24 they want to get rid of. What's different now on auto pricing?
There are a few factors at play here, and one of them is still the cyber attack on auto dealers that we saw in June. And so far in July, we've seen a bit of a rebound, about a 3.5% rebound in the pace of auto sales in July. So as those computer systems came back online, we saw auto dealers starting to sell more vehicles. But it also looks like they are offering discounts in part to offset the effect of higher interest expense for folks who are financing their cars. So we are expecting to see about a 1.5% decline in the price of autos, in the price of used autos in particular, in the CPI report. But again, the increase in sales volumes will probably buoy retail sales, headline retail sales in the July report.
Also out this week, retail sales for July. What do you expect to see overall?
The headline number is going to look pretty good, again, because of that rebound in sales volumes of autos. We're expecting to see a 0.4% increase in nominal retail sales in July. That's up from zero growth in June. So the headline's going to look pretty good. When you strip out some of the more volatile categories, though, like autos, like gasoline, like building materials and food services, I think we're actually going to see a decline. So that's what we call the control group for retail sales. And it's a pretty good indicator of consumer spending on goods within GDP. So that control group for retail sales, we think is going to decline about a 0.25 percentage point in the July data. And that's a material decline when you consider a June increase of nearly 1%. And that's because, again, people are relying on their credit cards a little bit less. They have less access to credit when they do look to take out their credit card. They're starting to pinch pennies quite a bit more. And again, they're looking for discounts where they can get it. So they're not going to be spending lavishly on some big ticket items like washing machines. Instead, they're going to be looking for discounts. We think that'll show up in the control group sales.
Boy, our thanks to Stuart Paul, U.S. economist with Bloomberg Economics. We continue with that discussion about the health of the U.S. consumer with a look ahead to some key earnings this Tuesday. Second quarter earnings from the nation's biggest home improvement chain, Home Depot. On Thursday, Q2 earnings from the world's biggest retailer, Walmart. To help us break down what those results could tell us, we're joined by Bloomberg retail reporter Jaewon Kong. Jaewon, thank you for joining us. And Home Depot often seen as a proxy for the U.S. housing market. So what do you expect to see from Home Depot's earnings?
Yeah, with Home Depot, consumers just aren't buying big ticket home products or projects right now, and we expect to see another challenging quarter. We also anticipate to hear that the business will remain challenging in the coming months, even if there are rate cuts, because there's typically a lag in consumer spending. As you said, the housing market remains tough and people are staying on the sidelines because of, high interest rates. They're just spending less on larger discretionary projects and instead spending on things that cost less, like gardens, lawns.
All right. So inflation, high borrowing costs, a lot of economic uncertainty. Well, I guess when you're hiring a contractor, it involves all of that. And so maybe you're not going to redo the bathroom or the kitchen this year.
Yeah. Instead of, spending, tens of thousands of dollars on a kitchen, people are either holding off or, they're choosing to do smaller DIY projects. And it's something that the company has talked about in recent quarters. And, we anticipate to hear that narrative again this quarter. I think investors expect that there could be a pop in the stock whenever the Fed, decides to cut rates. But, it's not like people start spending immediately after the rate cut. So I think this quarter and the rest of the year, it'll be pretty challenging.
Now, combined with a lack of housing turnover, you expect to see a bit of a pullback in Home Depot spending. What does it tell us about the housing market? And I know you're not the housing expert, you're a retail expert, but with Home Depot, with Lowe's, with Target, it's really got to impact consumer spending overall.
Yeah, what we've heard in recent quarters is that consumers are being selective. They're choosing to prioritize what they need versus what they want. So that's, translated to pull back on discretionary, products, projects, and, generally low to middle income consumers have been more stretched and under more pressure, and, upper income consumers are still spending. So, that's sort of the picture that we've seen from these retailers, and it'll be pretty similar this quarter as well. And, of course, we'll be on the lookout for any new signals about how people are spending, what they're buying, and, how they're choosing to prioritize.
Well, then let's move on, because that's a great segue into Walmart, where it looks like it is all about value for customers, and Walmart is providing it. So what do you expect to see from Walmart?
Yeah, with Walmart, right now is sort of, their time. It's, most of their business is in essentials. They are super focused on low prices, and we expect them to deliver another good quarter because of this. And with grocery at Walmart, it goes back to what we were talking about a bit ago, which is that people are prioritizing what they need. So grocery has been a bright spot for Walmart, and other categories, like general merchandise have been softer, and we're seeing consumers search for value, buying things that are on sale, or buying things that they think are good deals.
Who is reining in their spending, and what do we continue to spend money on?
Yeah, so with consumers, they have been resilient in that they are still spending, even with years of inflation. That being said, they are being what a lot of these companies have called choiceful. They are being selective. They're looking for areas to trade down, so to speak. So, instead of buying beef, you buy chicken, or, instead of buying name brands, you buy store brands. So I think consumers are looking for areas to save money. And, we're seeing that come through in grocery shopping and, in other areas of merchandise.
Well, we should learn a lot. Earnings this week from two of the biggies, Home Depot and Walmart. Our thanks to Jaewon Kong, Bloomberg retail reporter. Coming up on Bloomberg Daybreak Weekend, we'll examine the consequences of Europe's sweltering summer. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, we'll look ahead to the latest reading of Japan's GDP. But first, Europe is heating up with high temps in excess of 40 degrees Celsius this summer, a huge uptick from the norm. With climate change the likely culprit of the Mediterranean's tropical makeover, can the insurance industry keep up? For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, climate change is increasing the frequency and intensity of heat waves, bringing extreme weather events from flooding to wildfires across Europe. Just last month in Greece, wildfires were fanned by strong winds. In the Balkans, you saw burning forests and homes, which also forced the evacuation of a resort town in Albania. In North Macedonia, a blaze near the Greek border burned 5 houses and led to evacuations, and the damage spread to Croatia, a popular holiday destination, whilst in Bulgaria, firefighters had to stop fighting a wildfire in the mountains near the Greek border because of landmines dating back to the Cold War era. The volatile weather conditions in Europe really show no sign of abating. In the northwest of Europe, in France, in Germany, in the UK, we're expected to see the hottest temperatures of the summer in the next few days. Popular tourist destinations are on high alert for fires. The growing prevalence of extreme weather conditions is weighing heavily also on the insurance sector, often charged with the clear-up. Navigating the consequences is something that we've been discussing with the Munich Re CFO, Christoph Jurecka. He says that the unexpected conditions in Europe are affecting his company's bottom line.
Indeed, we have very pleasing results again this quarter, and after 6 months, we are now already at 3.8 billion euros of a net result. By the way, the highest net result ever we had after 6 months. So very well on track to achieve our full year guidance indeed. Now, the question is, why didn't we increase it probably? Well, I would say that's the typical Munich Re conservatism. We are cautious until the very end. And the third and the fourth quarter are very cut heavy in our planning. So therefore we thought, let's give it another quarter and see how the development goes and keep the guidance unchanged for now. But what is very clear, the likelihood of overachieving our target has significantly increased.
Okay, well, that's what it sounds like. Okay, so that's important. The likelihood of overachieving on that 5 billion euro profit target has increased. That's an important line, I think, for investors. Talk to us about some of these extreme weather events then. There are higher payment claims coming through for insurers and reinsurers. Are there some regions now that are becoming uninsurable?
Well, indeed, in the second quarter, again, we had a relatively high share of cat losses, slightly above our budget. Our average budget is 14% per quarter. This time, for us, it was 14.4, so slightly higher. And what actually happened was that there was not this one single headline event affecting us to that extent, but it was a number of smaller, mid-sized events, which then added up to that overall amount. The most significant for us this quarter was a flood in southern Germany, which altogether cost us in reinsurance around 200 million euros. But then there were other events across the globe, all of them rather mid-sized, which then finally added up to the number. So in a way, a busy quarter with not a single so significant event that it would have made headlines in the news.
Is it your assessment there is sufficient capacity within the insurance sector to be able to make up for what is expected to be the increased claims around climate change?
So our clear answer is yes, there is enough capacity. So we are very happy to deploy capacity into cat risks, always under the precondition, of course, that the prices and the terms and conditions have to be reasonable also from a reinsurance perspective. But under that precondition, absolutely, there's sufficient capacity in the market, and we are very happy to deploy more capacity.
Your business, Munich Re, has been a leader in terms of cybersecurity solutions within the insurance space. How big an impact was the CrowdStrike event within the industry and for you?
That's a very good question. I would love to know myself, but it's very early days. So I cannot give you any internal insights in any internal numbers yet. We're still assessing what's going on. I think the industry estimates, as for example, just shown in the media, they have come down a bit recently. But anyway, it's early days. We have to really assess it, wait for the claims notifications from our clients, and then we'll see.
That was the Munich Re CFO, Christoph Jurecka. So, are Europe's soaring temperatures here to stay? What does it mean for insurers on the one hand, but also for local people, for businesses, for holiday makers and so much more? I've been talking about that question with Bloomberg's energy reporter Eamon Farhat.
I mean, in the last few years, definitely last summer and the summer before, we've been seeing these increasingly record temperatures. You talked about in excess of 40 degrees. We actually reached even 46 degrees Celsius in Spain. I think that was last week. And I think the important thing is it's not just the high temperatures, it's also the intense heat for longer periods, affecting people's health, as you said, affecting wildfires. So it's definitely getting more extreme. And we're seeing that kind of summer period start earlier. We were already seeing heat waves in Spain in April and finish even later. We're expecting this heat to even continue into October for some places.
Okay, so the scorching weather is back then for another summer. How prepared are parts of Europe for this? Some places in Europe are fairly accustomed to wildfires, but how ready are Greece and other places?
Yeah, Greece has definitely been the center of kind of our wildfire coverage this summer. Every single day we have new blazes, on very popular tourist spots, popular islands as well, but also on the mainland. On the worst days in Greece, you will have, maybe 60 new blazes, but they are quite responsive. One thing that's quite interesting is there's much more of a kind of shared approach in Europe where, planes will be sent from, France or Italy to Greece to help out with wildfires. But at the same time, it is quite worrying when lots of countries in that area are under extreme risk of wildfires, as something very small could tip it all over to the edge.
Okay, so if it's a difficult wildfire season, then what sort of tactics have been developed? You say sharing equipment is one. How else can countries in Europe try to curb the damage?
Yeah, I mean, I think it's definitely, the shared equipment is a big factor, but also there's a lot more monitoring now. I mean, we have very advanced forecasts. The one thing is that wildfires are kind of driven by very dry conditions, by specific kinds of wind, and by quite advanced monitoring techniques, you can really tell almost exactly where they're going to take place. And then using satellite imagery, European kind of forecasters can also tell where the wildfires actually are, how they're doing with kind of controlling blazes, and especially for the bigger issues, that can really help to monitor situations and to make sure that resources are being used efficiently.
Do you think that there's a risk that wildfires could spread further north? I mean, let's say to the UK. Would we be equipped to deal with them? And would it get hot enough, dry enough here for that to happen?
Yeah, so I mean, I'm kind of checking these wildfire maps almost every single day to see what it's going to look like. And actually, into next week, there was an increased risk in the UK. We've seen that a few times this season where you kind of have this high or very high wildfire risk. Now, back in 2022, we had the hottest day ever. And on that day, we had some wildfires in London. About 20 homes were destroyed. And since then, there's definitely been a much bigger concern about wildfires in London and in the UK. There's been lots of consultations. There was kind of a whole period this year where there was people from fire agencies in Spain and France and Greece coming to London and giving their advice. In the end, that did lead to some kind of changes. Lots of the staff in London now are being trained specifically for wildfires. They're even giving recommendations to local council to really reduce that kind of risk of having barbecues in parks and trying to reduce all of those things that could create wildfires, because it is increasingly becoming a problem in the UK. We are seeing hotter summers. We are seeing it's not just about hotter summers, it's about having those specific days where the heat really spikes. As you said, into next week, there will be some days where it could reach 33 degrees. And although that doesn't seem too hot, that can be enough to cause some wildfires.
So then also the other big, market that is involved in this is insurers. The homes you talk about being destroyed. I mean, all of that has huge insurance implications. How are they dealing with the uptick and the issues around climate change?
Yeah, I mean, definitely when you take a step back, all of these kind of extreme weather events sometimes seem isolated, but as you said, there is a general trend about climate change making them more and more frequent, and insurers are definitely very aware of this. They've definitely warned about the risks of climate change, and although they're not kind of there yet, there are many insurers who have said that some regions, some places will become uninsurable in the future as these claims are getting bigger and more frequent. I mean, this year, the costliest event in Europe was actually a flooding event in southern Germany, which kind of came to about 5 billion, of which 2.2 billion US dollars was an insured loss. But whether it's kind of, the rains, the fires, or just the extreme temperatures, those losses are becoming more and more, and I said more and more frequent every year. So insurers are definitely kind of very aware of this trend.
And we have had warnings in recent years, numerous warnings of the risks of underinsuring for climate change. That's been a real worry of the industry. I mean, why do you think, Eamon, in particular, the fires are spreading to such an extent this summer?
The thing with the kind of fires is that it can even be a hangover from last year. It's about dryness in the soil, it's about the different winds, and if you have multiple years of pretty extreme temperatures, that kind of compound that effect. We've had about 2-3 years of pretty hot summers, so in Greece that's really becoming a problem. And it's also the fact that this can extend much later into the year than it would have. Otherwise, we'd have seen a wildfire season really focus on July, August. This year, early June, we were already seeing those wildfires expanding in parts of Europe, and it also puts countries on edge. I mean, Spain has been the focus of it for the last few weeks. There haven't been any major blazes, but everyone's kind of on red alert. It kind of causes some disruptions locally, and we have to be ready because it can expand. As I said, wildfires, just the nature of them, can mean that very quickly they can just kind of flare up and become a huge problem.
Are the fire authorities in various countries, are they concerned about what may happen next summer? I mean, we have had kind of an uptick and more close monitoring of these peak temperatures across different European countries over successive summers. Is there concern that this is going to get worse next year?
Yeah, I mean, when it comes to extreme summers, I think it seems that different forecasters always say that, they can't really tell what the weather will be like next summer. It's obviously a long way away, but more and more likely each summer we'll see records broken, extreme heat, and more kind of heat waves, which then leads to those fires. So that's kind of the general trend. I mean, we are having kind of an El Nino, La Nina effect. The El Nino is kind of ending and La Nina is coming in, which actually kind of reverses that trend slightly and actually causes more increased risk of hurricanes in the Atlantic, which is a whole other, other issue for insurers. But as far as temperatures go, records are going to continue to be broken. I mean, that's one thing we're kind of sure of. We got the hottest day ever globally in July. That was 2 days in a row we got that. We've been having consecutive months of record temperatures ever on Earth. So it just seems like things are getting hotter everywhere.
That was Bloomberg's Eamon Farhat there, as London, Paris and Berlin are braced to see yet more soaring temperatures and another summer of climate change impact. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thank you, Caroline. And coming up on Bloomberg Daybreak Weekend, we'll look ahead to the latest reading on GDP from the world's third largest economy. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Last week, global expectations for the Japanese economy and its markets were completely upended, making the path for the Bank of Japan's monetary policy less clear ahead of the latest reading of Japan's GDP out this week. Let's get to Bloomberg Daybreak Asia co-host Doug Krisner for a closer look.
Tom, before last week, the consensus view on Japan was that the economy was on the mend. Wages were rising, prices were up, inflation had returned and was proving sustainable. And after many months of being above its 2% inflation target, the Bank of Japan tightened at its July meeting. BOJ Governor Kazuo Ueda said the decision was based on data showing developments on the economy and inflation were in line with previous expectations. Earlier, I spoke with Stephanie Leung, Chief Investment Officer at Stashaway, based in Hong Kong, and I asked for her view on the BOJ's recent move.
Given that Japan has gone through a deflation for the last 30 years, it's prudent for the BOJ to kind of be a bit more conservative in their move. I think the problem with the recent move is perhaps more in the timing of things. So they picked the summer, I think, when liquidity is actually quite thin and a lot of people are on leave. They kind of wish that they could move the currency with this kind of thinner liquidity. Perhaps they got much more than what they wished for, in the sense that it moved the currency in a very, very violent way. At the same time, they stopped ETF purchases as well. And that, let's remember the reason why BOJ is hiking is because, they are actually quite confident of the way the economy is going. So I think in terms of fundamental story, there's still a lot of progress, but a lot of this is technical.
Stephanie Leung there from Stashaway. Now, the point she made about Japan being in deflation for 30 years is important and not to be underestimated. You know, there's an entire generation in Japan that's known only deflation. Now, the other thing to consider in all of this, especially in the last several years, is the strength of the U.S. dollar. That has added to Japan's inflationary pressures. I also spoke earlier with Carlos Casanova. He is senior Asia economist at UBP.
First have weak yen triggering imported inflation. As a result of that, you instigate changes in corporate behavior, including increasing wages. The increase was the highest in 30 years, so definitely that part of the cycle has materialized. And then down the line, that should translate into stronger domestic consumption and endogenous inflation. The third part of that puzzle is what we haven't quite seen yet, although data did show real wages increasing by 1.1% for the first time since 2021. But in and of itself, that is not sufficient to justify the hawkish pivot. So I think inflation has been high, but it's predominantly driven by US dollar strength. And so Bank of Japan really has taken a gamble here because the preliminary data does point towards this virtuous cycle sort of taking hold in the second half of the year. But they moved ahead of having visibility on that front.
He is Carlos Casanova, senior economist at UBP. Joining us now for some discussion on the Japanese economy and the BOJ is our own Paul Dobson. Paul is Bloomberg executive editor for Asia Markets. He joins us from Singapore. Paul, the reaction in markets to the BOJ's tightening should really come as no surprise, especially directionally in terms of yen strengthening. I think it's fair to say that it was magnified by that unwinding of the carry trade, to be sure. How are you making sense of the ripple effects that we have seen in markets?
So I think that the starting point has to be to think about that carry trade and how much of the world has been taking on these leveraged bets based on the yen being the last kind of funding currency at particularly low interest rates that's out there. And so that really has snowballed in recent years and become a very important theme. Now, on top of that, you've had further depreciation in the yen for much of this year, and that's partly the BOJ's fault. So listening to some of what you've been saying already just now, the Bank of Japan was very, very slow and very, very careful about when it's going to choose to raise interest rates. The market had been expecting it to come, earlier in the year, and the BOJ chose not to move on a couple of occasions when the window was already open. It had kind of nurtured the market, but to such an extent that people had gotten very complacent about the idea that the BOJ wasn't going to move aggressively. So for them then to do this hike at a time when maybe the market wasn't quite so well prepared did really cause something of a shock and start the sort of snowball rolling down the hill in terms of yen appreciation. What they couldn't have foreseen, and what was particularly bad luck, was that 2 days later we'd have that really weak payrolls data out of the US, which led to a weaker dollar and increased bets that the Federal Reserve will need to start cutting interest rates soon. And that really was the second kind of push that really ignited that big unwind in the carry trade and then sent those ripples across the rest of the world's financial markets.
So what have these developments done to the thinking on what the Bank of Japan may do next? Do you think they're going to be much more cautious now that they've become, I don't want to say scared, but very concerned about the way in which markets have been trading in this volatile fashion? Or are they going to lean into solving the inflation problem in Japan? Which is it?
So after 2 days of very volatile moves in financial markets, we heard from the Deputy Governor Uchida, and he seemed to seek to calm those expectations somewhat. You might call it activating the BOJ put. He said, hey, if markets are very volatile like this, this isn't when the BOJ is going to continue to be hiking interest rates. That would be kind of counterproductive. So he stilled some of the worst fears in the market about how fast the BOJ may move and what sort of circumstances it would be looking at for those moves. And that did do something to settle things down. The longer-term expectations aren't exactly for the BOJ to be moving aggressively. A lot of the analysts are talking about December or January for the next hike, and the market is not pricing in a very aggressive path. What we'd had from the BOJ when it raised interest rates was a discourse that seemed to suggest that it could be moving much more quickly than that. Now the market is back to pricing a more gradual pace, and maybe that will be enough to help to assuage some of the worst fears in the market. But what we do know is that the BOJ is determined to continue with its hiking path, all other things being equal. And so longer term, those people that have those long leverage positions based on the premise of very low interest rates in Japan will need to think twice about whether they want to hold on to them.
As I mentioned earlier, in the week ahead we'll be getting the Japanese second quarter GDP print. Again, here is Carlos Casanova, Senior Asia Economist at UBP, on what we are likely to see.
It's a backward-looking indicator, so I think it's going to disappoint. Remember that the economy was in a recession in the first quarter. Consumption and capital expenditure was contractionary as a result of high inflation, squeezing purchasing power of households in Japan because all of their imports, Japan is a net importer and all of their imports are more expensive. But also companies have been adjusting to higher nominal wages by reducing the amount that they spend on capital expenditures. So I think that trend is going to continue into the second quarter. And of course, if we see a disappointing GDP reading, that is going to be quite negative for markets.
That is Carlos Casanova from UBP. Back to my colleague Paul Dobson in Singapore. What are we expecting here in quantitative terms on the GDP print? Do we have a number?
We do, and it's not an unfavorable number based on analyst estimates. Expectations are that quarter-on-quarter GDP will increase 0.6%. That's after minus 0.7% the previous quarter. So finally, some growth at least is what the street is looking for. I think it's interesting what Carlos Casanova was saying there. I don't know whether good news or bad news is worse for the market right now. If the growth is too strong, then the market might start to reprice the BOJ expectations again for a more aggressive stance, and that might whip up the volatility that we've been seeing in recent days again. Whereas obviously too weaker number, and people will be worried about the growth outlook and whether the BOJ will be able to hike at all from here. So, it will certainly be a number that there'll be a lot of focus on and could cause quite a lot of volatility as well.
I want to take a brief look at household spending in Japan, because data that I looked at in the most recent week indicated a second month of decline during the month of June. And as I understand it, Paul, household spending in Japan accounts for more than half of overall domestic GDP. When you look at the state of the consumer in Japan, what do we see?
So I think, what we want to do is go right back to the start, what you were saying earlier about, how a whole generation has lived through this kind of deflationary environment, and how we're finally at a point where we've got some wage growth coming through the economy. We've got companies feeling like they do have some ability to raise prices. We're getting back into an inflationary mindset. That's really what the BOJ wants. It's what the government has been pushing for as well for a long time. And that's why they've been so very careful to try to not disrupt things, to try to be able to raise interest rates without causing too much disruption, and probably why they're alarmed by what we've seen in the markets in reaction to that rate hike. So they will want to see continuing wage growth, and they will want to see continuing confidence among consumers to keep on spending, and they will want companies to be able to continue to raise prices as well, to have that pricing power, which we hadn't seen for so long and we have been seeing in Japan in recent years. That said, we are seeing a little bit of a slowdown, a little bit less confidence among consumers at this moment in time, and that will be troublesome for the BOJ, So what I think the next really big kind of talking point will be for the policymakers comes around October time, when we'll get more wage negotiations, when we'll be able to see if pay growth continues. And if that does, then hopefully that will give the consumer the confidence to continue spending, and that will continue that inflationary cycle that has just about kind of been established but is still very fragile.
I think it's important to point out at the same time that the weak Japanese currency has played a very crucial role in supporting many major companies in Japan, especially those exporters. The value of their earnings overseas is boosted by that weakness. And if you look at a company like, say, Toyota, recently reporting record profits. So this cuts both ways, does it not?
Yeah, absolutely. I mean, so you on the one hand, you do have the benefits for those exporters of a weaker yen. On the other hand, if the yen does strengthen, then it should make things a little bit better for importers, and therefore should make it a little bit easier for the consumer as well. So it does cut both ways. I think what we saw is that the yen weakness was just so pronounced that even those companies that have benefited from exporting in the past, even they were complaining the yen was too weak and that they would rather see it stabilize or strengthen a little bit. So from that perspective, at least, they're behind the idea that the BOJ should be hiking and should be pushing the currency stronger again, just not please very at these humongously aggressive pace of change that we've seen over the past few days.
Paul, thank you so much for joining us and helping us understand a little bit better what's been happening in Japan and where things may go from here. Paul Dobson is Bloomberg Executive Editor for Asia Markets. I'm Doug Krisner, and you can join Brian Curtis and myself weekdays here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong, 8 p.m. on Wall Street. Tom?
Our thanks to Doug, and that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.